On today's hot sheet, I'm discussing house price indices from Case-Shiller and FHFA, both released this morning, plus a housing inflation report from the Federal Reserve Bank of Minneapolis and a tweet that's getting a lot of attention around it. Today is Tuesday, July 30th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know in the live chat which market you're tuning in from. And my apologies yesterday for our lack of great internet. I know the audio was off yesterday. I hope that it is back today to your normal expectations. I can almost all but guarantee that when I get back to my Florida studio, that will not be happening. Haley is smiling. I am looking forward, Haley, to getting back to my Florida studio. Here in Connecticut, Tucky, we will try to get our, nothing against Kentucky, obviously, but we will try to get our internet going here. We have fiber, by the way, but I don't know what's going on. We're gonna get that fixed, and hopefully today we are good. Jason says sounding great. So there we go. Jeremy, Bobby's not with us here today, and we'll just blame yesterday on Bobby because yesterday, and I said this to Bobby, I said, I think yesterday's hot sheet, unfortunately, like content-wise and even maybe delivery was my best hot sheet, particularly in recent memory, maybe of the year. And somehow Bobby / the internet just completely screwed it up. All right. We've got Case-Shiller and FHFA. We're going to lead off with those two, but in the third spot, I've got a tweet from Mark Zandi, chief economist of Economics. He's a podcast. Mark Zandi, really well-known economist. A tweet that's getting a lot of attention, and it's something that is of particular interest right now because we're leading into today and tomorrow. The FOMC meeting kicks off Jay Powell week. So a little shout out to Jay Powell. Hit the thumbs up here on the YouTube video for Jay Powell. The FOMC meets today, meets tomorrow. And this tweet has really important timing. It's something that we've talked about a lot and has to do with inflation and how high really is inflation. So I'm looking forward to breaking that down for you. But first, let's get to the S&P CoreLogic Case-Shiller home price indices. They're the leading measures of U.S. residential real estate prices. We often refer to Case-Shiller as the gold standard when it comes to U.S. home prices, tracking changes in the value of residential real estate nationally. Okay, so the gold standard, with that comes obviously a lot of accuracy, consistent accuracy over a long period of time. But to be that accurate, the data is lagging. It's lagging considerably from where we are today. We're sitting here at July 30th, FOMC meeting kickoff day, and we're going to be into August here in just 2 days. And just this morning on July 30th, they released their May results. So, come the first week of June, if you're an agent or you have access to your local MLS, you can get a pretty good snapshot for May. You may want to be ultra safe and wait till June 10th or the 14th before you send out that official market report or talk about it on your show locally or whatever the case may be, before you put that data out there to your clients, to your people that live in your communities. Let those deals kind of trickle in and work their way through the system there that first week of June. Let those closings post, all of that, and get accurate data. But by the middle of June, you got a really good understanding of where you came in. And even in that first week, you got a pretty good snapshot of what the market did for May. We're sitting here basically in August looking at May, but that's what you get with the Case-Shiller numbers. These are going to be, and that's every time I say when we go over Case-Shiller, it's like, okay, we're kind of almost recapping what we've been looking at with maybe a Zillow or a Realtor.com, where the numbers come out a little bit more in real time, a little bit, sooner. All right, the S&P Case-Shiller covering all 9 U.S. consensus divisions reported a 5.9% annual gain from May. Now, the headline here on the press release from Case-Shiller is breaks previous month's all-time high for May 2024. That being said, we are down from a 6.4% annual gain in the previous month. So we're starting to see this deceleration on the home prices that we expected to take shape at some point in this year. Looking at May and already seeing it, maybe a little bit earlier than we expected, but it is taking shape, and I expect that to be more of the conversation as we go throughout the year. A deceleration of home price increases, not home prices dropping, but a deceleration of how big that increase is. All right, the 10-city composite saw an annual increase of 7.7%, down from 8.1 annual increase in the previous month. The 20-city composite posted a year-over-year increase of 6.8, dropping from 7.3 in the previous month. So the 20-city, the 10-city, and nationally all seeing this deceleration so far on this Case-Shiller report this morning. New York, the Big Apple, reported the highest annual gain among the 20 cities with 9.4 increase in May. The city is heating up, followed by San Diego, Las Vegas, with increases of 9.1, 8.6 respectively. Portland once again held the lowest rank for the smallest year-over-year gain, notching 1% increase in May. By the way, when you say the city, there's only one place on earth you're talking about, and that's New York City. I hear sometimes on the West Coast, people like, the city, LA. You can't say the city and LA. Doesn't work. If you're from the Northeast, you get that. The only place you call the city is the Big Apple, New York, sitting at number one, surprisingly, on this home price gain. If you're a West Coaster, you can debate me, or maybe you watch the replay and you're not able to debate me here in the live chat. All right, let's take a look here at some of these regions. We'll take a look first at, I guess this would be, some of the metropolitan areas. Then we've got the composite 10, the composite 20 in the U.S. National to compare it all to. Here we go. Atlanta year-over-year change 5.7, in line nationally. Boston, Charlotte, Chicago, Cleveland, all above where we're at nationally. Remember, U.S. National, we're sitting at this 5.9% number all the way at the bottom of the chart. By the way, the charts, tables, available for you inside of BAMX. If you're not in BAMX yet, use code HOT with the link down below to get your discount off of BAMX. We release our hot sheet show notes and our slides and tables each and every single day inside of BAMX, along with your monthly courses and all of the content that we do for you inside of BAM in a Box every Friday. All right, so Cleveland, Chicago, Charlotte, Boston, again, over the national number there, annualized. Dallas, well below at 2.6. Denver, well below at 2.1. Detroit, up 6.9. Vegas, up 8.6. LA, not the city, but just LA, 8.4%. Miami, 7.6%. Minneapolis, down below the national gain at 2.4. New York again at 9.4. Phoenix 4.4. Portland coming in the lowest on the 20-city composite at 1% up. San Diego booming 9.1. San Fran 4.3. People from San Francisco don't like, Haley, when I say San Fran. They say don't say that. Don't say San Fran. And you got somebody here. San Francisco people are screaming right now, the city. No, San Francisco's not the city, and I'll San Fran you all the time. Okay, there you go, San Francisco. Seattle 7.1, Tampa 3.3, Washington 6.1. Again, the 10-city coming in at 7.77, and the composite 20 coming in at 6.6, both above U.S. national numbers. Now, taking a look at monthly changes using the seasonally adjusted and non-seasonally adjusted data, this is what we've got. So this is just basically the May-April change percent, and we've got and then you've got April-March to the right. But we'll look at April-May percent change. The biggest risers were Detroit. When you look at seasonally adjusted, I'm looking at that number to the right here. You've got Detroit as a big gainer. They're in fact the biggest when you just look at the May-April percent change. New York coming in at 0.8%, and Cleveland at 0.7%. Phoenix and Portland were down. Dallas was down just a tick as well, in the negatives, that is. Okay. So there you go. Month over month. Composite 10 was 0.4% increase on that April through to May. You've got the 20 city at 0.3 and the US National at 0.3. If we look back, rear view mirror, going back to March, April, everybody was in the positives except for Phoenix, which was down negative 0.3%. The 10 city, 20 city were both up above the US National, which remained at 0.3%. Okay. There's your Case-Shiller rear view looking mirror again on Case-Shiller data as it is lagging. This is reporting on May, just released this morning. And of course, we are now entering almost August. All right. We've got the FHFA Housing Index monthly report. I tend to like this one a little bit better. Both released at the same time. This one's also through May of 2024. But let's take a look at what FHFA says. Okay, up 5.7% from last year, unchanged in May. U.S. house prices were unchanged in May, according to FHFA. They rose 5.7% from May 23 to May 24. Previously reported 0.2% price increase in April was revised upward to 0.3%. They do 9 consensus divisions, regions. Seasonally adjusted monthly prices from May 2004 to May range from 0.5% down in the West North Central division to plus 0.3% in the New England division. Okay, so the 12-month changes were all positive, ranging 2.4% West Central to 9.2% New England division, where you've got all of the inventory issues that are being created there. All right, so let's take a look now at my favorite chart of all time. This is the chart that you show buyers who say, well, prices have got to eventually come down. Well, if we go back to 91, the only time they did was when we had a mortgage crisis and everybody lost their jobs. Are we anticipating that right now? How confident are you that that's going to happen right now? And so, nobody's confident that's going to happen. There's no data that backs it up. You could walk somebody through that education process pretty quickly, that's going to be the one blip on the radar. And other than that, home prices go up and to the right. Here's the monthly house price. This is monthly. Every month that you wait, you continue to see those home prices tick up to the right, going all the way back to January 1991. A lot of home buyers right now were probably born around that time frame. When you take a look at millennials have now taken over the number one buyer demographic. Okay. Once again, here are the 12-month house price changes. Prior year versus most recent year. Again, U.S. at this time, prior year was 2.9, now 5.7. So U.S. home prices screaming. This year, we are seeing that deceleration. We expect that to continue throughout the year. Pacific is up 3.7 when last year down negative 1.6%. The Mountain is up 5.1 after last year being down 3.1. West North Central region up 5.2% when last year was only up 4.2. West South Central is flat with last year, 2.4% respectively. East North Central up 7.1%. Last year was at 5.6%. East South Central up 5.2 versus last year's 4.8. New England 9.2 versus 3.7. New England region just has so many inventory issues compared to the rest of the country, where we're seeing healthy gains. And so once New England's inventory, if it does catches up, you'll see this deceleration there. Middle Atlantic, 8.9% versus 4.9. South Atlantic, 6.3 versus 4.1. So there you go. I'm being told I can call it SF, but not San Fran. People don't like it when you say San Fran. SF seems more acceptable than San Fran. You just can't call SF or San Fran the city. That is reserved for the Big Apple, New York City. I guess I'm showing a little bit of East Coast bias there, but does happen to be completely true, of course. All right, getting back to FHFA. Here's the 12-month house price versus the current 12 months versus the previous 12 months. Okay. Again, that we saw the bar graph. If you like the table better, here it is. This table will be available for you inside of your BAMX hot sheet show notes and downloads there, which we release every single day for you, can grab those and you can grab your BAMX subscription if you're not in by using code HOT today. Anything else here on FHFA? The deputy director, rather, for FHFA's Division of Research and Statistics said this: U.S. home price movement was flat in May. The slowdown in U.S. home price appreciation continued in May amid a slight rise in both mortgage rates and housing inventory. And so there you go. You're seeing it both with Case-Shiller, now FHFA, saying, hey, we're seeing a depreciation. It's slowing down. Home prices are still appreciating. We're seeing records, all of that. But that is slowing down and expected to continue to slow down when we get the seasonal slowdown here later on in the year. Okay, they're not saying what Glenn Kelman from Redfin said yesterday, which it was, he said it was, home buyers are paused because of huge election concerns, which interestingly enough, Eric posted on the @NowBAM Instagram yesterday. And I'll bring that up if I can find that. I will find it. I'm confident in my abilities to find something on Instagram here. He posts this. Okay, so we covered this on the hot sheet yesterday. Unfortunately, the audio in yesterday's hot sheet was being impacted by the internet quality that we had going on here yesterday. Anyways, we posted this from that topic on the hot sheet on Instagram. Housing is a funk due to election uncertainty. This is a Glenn Kelman quote. Housing is a funk. Even though interest rates have dropped 20 to 30 points below the last weeks, we've seen homeowners still on the sidelines. The real issue might be the election. This is where I took a little bit of, issue with here. The real issue might be with the election. We've talked to so many home buyers who say they're going to wait to see what happens in this election. It is gripping the national psyche, as you may have heard. I think these comments are insane. We've seen a home real estate recession for 2 years now. Okay. And 2 years ago, nobody was paying attention to this election. A year ago, nobody was paying. Obviously, the last month, 2 months, there's been a ratcheting up of all kinds of, nonsense and rhetoric from, both sides in this, heavily, what will be a heavily contested election cycle. When he was talking about home buyers, when you talk about home buyers, the last 2 years, what has impacted them the most? It's been affordability. If they could afford a home, people who desire to buy a home, want to buy a home, if they could afford to buy said home, they would do that regardless of, who the president may or may not be or what the election cycle may bring. But to my surprise, a lot of people are saying, hey, the election is a factor, and we're hearing this. Some people said they never, nobody has said this to them, but there are people who are saying that they are having clients mention this to them. Now, what I would agree with and what I said yesterday, I just want to make this clear. What I would agree with is that you're going to have sellers more so than buyers say, should I put my house on the market now or wait until after? There's a lot of uncertainty going on. We cover this on Knowledge Brokers podcast on Friday, myself, Tom Toole, and Lisa Chennai. So you can get my full thoughts on that. We broke down, Keeping Current Matters commented on this post. We broke down their charts, which show that real estate doesn't have, after the election, a huge impact. Typically it'll go up. Okay. So that also could be a case where, okay, if real estate usually goes up after election and some people are thinking about pausing, what's your experience been shopping right after an election? If you're pausing now, or other people thinking about pausing, and shouldn't you maybe get out there and do it with the less competition? I'd make that argument against the rates. Okay. Because if the rates are actually going to go down, with a rate cut, we're going to get into some of the rate stuff here in just a second. Fascinating stuff on X from Mark Zandi. But if the rates are going to go down, I might want to go out there and be shopping right now. But listen, this is classic Redfin stuff. This is classic Glenn Kelman stuff. If you read any of their any Redfin stuff, they try to be political activists, just based on the Redfin Corporation and how successful that company is. They should spend more time serving and understanding customers than they should trying to grab these politically driven headlines. That's my thoughts. Maybe you feel differently. Share them in the comments. Totally cool with that. And I don't think there's going to be a lot of buyers that if they could afford a house right now, true buyers, true 60 to 90-day buyers that, if they get the right rate, if they get the right deal negotiation on a house and they can afford it, certainly if they've been shopping, are truly going to pause. Now, they may have some questions about it. It's your job to educate them on what that might look like. But I would say I would lean more towards sellers. And historically, that's been the case. For those of us that have been selling for, multiple presidential elections, you see it from the seller side, where the sellers are like, why would I list mid-October when I'm 3 weeks away from the election? Do you think I should just wait through election, wait through Thanksgiving, wait through all the holidays that happen at the end of the year, and we plan on hitting the spring market at the beginning? That is something I've consistently heard through presidential election cycles. Not so much on the buy side. Okay. Right now, you get an interest rate cut that comes down. I don't care if Mickey Mouse is about to be president. They're going to be buying if you get interest rates to come down low enough. You're going to see movement in this market. It's going to be rate driven. It's been rate driven for the last 2 years. And Mark Zandi makes the statement that maybe, just maybe, he's the founder of economy.com, by the way, Mark Zandi, formerly from Moody's for sure. Mark Zandi makes the comment that we should be cutting now. We shouldn't be waiting. Okay. We should be cutting interest rates right now. Okay. So here's the tweet from Mark Zandi. Take a look at this important recent paper. We're going to take a look at it right here by researchers from Minneapolis Federal Reserve. Minneapolis Federal Reserve does put out a lot of work on what's happening here in inflation. He's got the link. The researchers conclude that the optimal monetary policy should largely ignore shelter prices and target price stability in the non-housing sector. Thank you, Mark. For those of us that have been with, the hot sheet here all year, have we been saying this for sure? There's a WAPO I don't think it might be an op-ed. Yeah, it's an op-ed. Jim Parrott in this Washington Post op-ed. Exactly the point I made with Jim Parrott on this op-ed. WAPO breaks it down. We're going to go through that. We've been making this point on the hot sheet all year and into last year. Okay, so so glad somebody like Mark Zandi is saying it, putting out a tweet that's getting attention, yesterday. So pre-FOMC getting together today. Hopefully somebody forwards this to Jay Powell. Of course, the Fed researchers came to this in a much more elegant and rigorous way. Hopefully their Fed colleagues who set monetary policy heed their advice. Okay, so he's talking about today's meeting. Hey, take a look at what Minneapolis Reserve is saying. Take a look at what this WAPO article is saying. If they do, they have a bright green light to begin cutting rates as non-housing inflation is already firmly at or even below the Fed's target. Okay, this is what we're looking forward to. This is what we've been saying here on the hot sheet for quite some time. Okay, so here's the paper. Here's the white paper from Minneapolis Fed. How should monetary policy respond to housing inflation? This will be available for you to grab and download inside of BAMX. Use code HOT to grab that. Okay, this is a 35-page paper. There's a lot in here. A lot of this is, could be very useful for you to kind of educate yourself on that owner's equivalent rent versus what the rest of the world does. We covered probably almost a year ago, maybe it was the beginning of this year. We covered a Wall Street Journal article that said just this. Okay, this was almost a year ago. Wall Street Journal made the case that if we tracked inflation like the rest of the civilized world, okay, that we'd actually be at the Fed target rate. Okay, we'd be at 2%. We would have been at 2% last year. We could have been cutting this entire time if we tracked inflation like the rest of the world, where we don't, weigh 36% of inflation on this made up phony number, which is owner's equivalent rent. So that 35-page paper, could be valuable to you if you want to really get educated on that and really understand that. And we'll have that available for you inside of BAMX. Some of the background and the context is just broken down for you inside of the hot sheet show notes that we give you after every single show inside of BAMX. You can copy and paste this stuff. This is great stuff to use inside of your email marketing, your communication with clients, all of that kind of stuff. So surge in rents and inflation, significant increase, obviously, has been above the target in many countries. You have models and assumptions. This traditional new Keynesian model assumed production is based on demand, but it doesn't fit well with the housing market, which is more likely controlled by supply, right? So they make the argument here in this paper that supply is what drives housing and not these other factors like owner's equivalent rent, which is, a made up number where, they're going to be talking about if you do a survey on a homeowner, hey, what would you rent your house at? Well, if they're living in, suburban market where you don't have a lot of rental, they're going to get a really high rent for it because there is no supply there. But are you really going to have a lot of, potential renters looking in that neighborhood? No, because you traditionally don't have rents in that neighborhood. Housing market characteristics: housing supply cannot quickly respond to increased demand due to the time required to build. Obviously, that's been a big topic here. Optimal monetary policy findings. The optimal policy should stabilize the non-housing sector and largely disregard housing inflation. There you go. A lot of homeowners right now aren't dealing with housing inflation. They're locked in under 5%, or 40% don't have a mortgage at all. And then if you're, somebody that's going to enter the housing market now, well, there's a huge difference between what I'm going to pay and what I can go out and get for a rent. I can get a much more affordable option for a rent. And so I'm probably going to go take that right now. And that's where you've seen this plummet, obviously, on transactions. Okay. Mark Zandi, we read the tweet. I think he's right on the money here. And we'll go to this Washington Post op-ed that he was commented on. Maybe the best op-ed I've seen from WAPO year to date. Note to Fed: it's okay to cut interest rates now. Okay. Jim Parrott, he's the owner of Parrott Ryan Advisors, non-resident fellow at the Urban Institute. I want to be a fellow some point in my life. Fellow, whatever. Maybe we should start BAM fellows. You get those Consumer Federation of America fellows. They sound very smart. Okay, so fellow at the Urban Institute, Mark Zandi, he's the chief economist at Moody's Analytics. Okay, also founded that economy.com. He's got Moody's out of his X profile, so maybe he's trying to move away from the Moody's thing. I don't know. It's time for the Federal Reserve to declare war on inflation, and the Fed's aggressive rate hikes have helped cool inflation, but its insistence on keeping these rates higher for longer is based on serious misjudgment of the role of the cost of owning a home plays in inflation and threatens to do unnecessary harm to the economy. By the way, there's only two ways home prices are going to come down, right? So we'll get into that. There's only really two options here as we move forward with the Fed if they want to get this thing down to the 2% target, so to speak, and how it relates to housing. And we'll go over that in just a second. The Fed targets inflation as measured by the change in personal PCE. That's their favorite number. We went over that yesterday. Again, yesterday's audio is a little bad, so if you go back and just bear with us on that. Second half was a little bit better. Tracks the price of a representative mix of goods and services purchased by a typical American. This measure inflation peaked at well over 7% 2 years ago, followed in below 3% today. It still remains above the 2% target. Okay, CPI follows a similar pattern. CPI is what the investors like. PCE is what the Fed likes to cover here. Here's the PCE that we covered yesterday. Okay, great. These are, however, flawed measures of inflation. Yes, they are. We've been saying that here on the hot sheet. Relying heavily on an ill-conceived notion of the cost of home ownership. Both attempt to capture the cost of home ownership by estimating, not by actually looking at real numbers, but by estimating the rent a homeowner would pay for a similar home nearby. This is problematic for two reasons. Okay, so this is what owner's equivalent rent is. When you look at CPI, which we do every single month here on the hot sheet, it's weighted 36% in inflation. Owner's equivalent rent out of the 36% the shelter makes up is up over 1/4 of the total CPI. It's up over 25%. Owner's equivalent rent is a 1980s made up survey where they go around and literally do this, estimating rent a homeowner would pay for a similar home nearby. Hey, if I came to your house and flattened it and you didn't have it anymore, you didn't own it. I know you have a 3% locked in mortgage rate. But if I came down your neighborhood and steamrolled your house and you were out on the street and you had to go rent a similar home nearby, what would you pay for rent if it was the same as your beautiful, fantastic home? And then somebody who actually answers their house phone or fills out this mail says, "Oh, well, gee, I think I'd get $1 million for my home." Okay, this is what they're using to actually come up with owner's equivalent rent. Okay, so first, using this rental equivalent approach badly miscalculates the actual cost of owning a home when the costs of renting and owning diverge as they have in today's market. The vast majority of American homeowners either don't have a mortgage, same fixed cost rate. Last year, we talked about that. They are paying similar housing costs, yet their implicit rent has gone up along with that of actual renters, okay? The rent equivalence approach breaks down further when the owner-occupied stock is different from the stock of rental properties, okay? You're asking a homeowner, hey, what would this similar home be to rent? Well, there's not a lot of supply. We're going back to the supply. There's not a lot of supply of those beautiful homes. What would your 5-bedroom, 3-bath home, rent for? Well, rent for a lot because there's not any of them available. Okay, there's plenty of apartments available. There's not any of these homes available to rent. So yeah, it's going to rent for a lot. Yeah, it's a big home, and it's inflating these numbers. It's virtually impossible, for instance, to come up with the useful measure of implicit rent for homeowners in communities where most of the homes are owner-occupied or where the rental stock is almost multifamily. Simply isn't enough inventory, okay? Because of these and other challenges in measuring the cost of home ownership, most developed countries, besides the U.S., treat owner-occupied housing as an investment and exclude it from their inflation estimates. Yet in the U.S., it's given more weight than any other good or service tracked in the two preferred measures of inflation. If the Fed followed the sensible lead of the rest of the developed world and removed this variable from its measures, it would find that inflation is right on its 2% target and has been there since last fall. But the Fed, and Jerome Powell's answered this question, we've covered this question in the past. Jerome Powell says, we don't want to change, how we measure this. We've been doing it in the 1980s. It take a lot of work to change. And, then you're not going to really be able to compare, this era from last year. It's like, what do you do with the steroid era in baseball? When Barry Bonds' head grew 3 sizes and he started just smashing 70 plus homers a year out of the park, that's why he's not in the Hall of Fame. It's like, how do you compare those stats versus these stats? Now in the NFL, it's like, how do you compare a 17-game schedule versus 16-game schedule? All of this kind of stuff. Well, I don't know. You just figure it out. You just say, hey, post 17-game schedule that, these are the records after 17-game schedule. You just change the stats using apartments.com, CoStar, these types of relevant information that we have. And you say, hey, before when we were bozos, you looking at owner's equivalent rent, these are the numbers. And now post changing the measurements of inflation to be more relevant to the world we live in, this is what we're looking at. When you want to do comparisons, that would be how you would do it. More important than mismeasuring the cost of owning a home, however, is the Fed is basing its ongoing higher for longer strategy, misunderstanding what's actually driving the cost of home ownership while raising interest rate weighs on the prices for most goods and services by reducing demand. Its impact on the cost of home ownership is more complicated. The primary driver of the painfully high cost of owning a home is the supply shortfall. Yes, bingo. For years, supply of homes to rent or own has fallen well below the demand. The situation obviously has been exacerbated in the recent years. So that's the punchline, and it's the same punchline we've been driving here on the hot sheet for quite some time. So I'm glad that the WAPO put this op-ed out there. It happens to be very accurate. Wall Street Journal reported a year ago, so you're just a year late. Washington Post. Mark Zandi from Moody's talking about it in his tweet, getting some attention on X. And obviously now the Minnesota Federal Reserve Bank of Minneapolis, rather, is on board with this and has a big white paper that at least hopefully you'll see, the FOMC maybe will take some consideration into that. All right. If we were to track it like everybody else, we'd already be at 2%. And this would be the case for cutting this week, which again, we went over yesterday, is a very small chance that we'll get a cut. It's 100% chance that we'll get a cut on the September meeting. We'll break down everything that Jerome Powell says. And if he alludes to a cut when this meeting wraps up, we'll be doing that Thursday morning on the hot sheet. Hit subscribe if you haven't done so yet on this YouTube channel. Hit subscribe here. I know last week with everything that we broke around the EXP forums conversation, we had a whole bunch of new subscribers, so thankful to have you guys. Today's real word is going to get posted. Last week's real word completely just went crazy as we broke that story there about the EXP stuff, and then obviously led to the live the following day. This week's real word, recapping that and maybe having a surprise guest, I don't know. I'm waiting. I'm going to look at my text here and see possibly happening. I'm going to be recording right after this. That'll be up later today. So make sure you're subscribed to the channel so you don't miss any of that. 10-year treasury coming in here on this Tuesday at 4.171. It's been kind of just bouncing a little bit here today. Got down as low as 4.155 at one point, now up to 4.171. 30-year fix didn't get quite down to that 6.25, 3/4 range that I wanted it to. Yesterday came in at 6.81. That is down from Friday's end of the week, 6.86. All right, there is your hot sheet for the week. Use code HOT to jump into BAMX. I'll see you later on here on the channel on the Real Word Pod. Until then, of course, toodaloo.